What's all this business about Goldbach levels?
ICT has claimed that he either wrote the algorithm that prices the markets, helped write it, saw the code, or was briefed by people who wrote the code. So I wanted to investigate whether this was true or not. And my underlying premise was if he was somehow involved in writing the code, then his strategies should be based purely off of the code, and he should not have borrowed or expanded upon the teachings of traders who came before him. So I used ChatGPT to accelerate this research for me, and I think you'll find the output very, very intriguing. I'm interested in investigating whether ICT borrowed a number of concepts from other traders. Could you please examine whether any of ICT's trading concepts may have been borrowed or expanded upon Chris Laurie's work?
Chris Laurie is a respected figure in the trading community, known primarily for his focus on institutional order flow and price action in Forex markets. Given the similarities in focus between Chris Laurie and ICT, Michael, it's worth exploring whether some of ICT's concepts might have been borrowed or expanded upon from Laurie's work. Below is a breakdown of key concepts and comparisons between the two traders, particularly focusing on whether ICT's ideas could have been influenced by Laurie. 1. Institutional order flow. One of Laurie's major teachings revolves around understanding institutional order flow. He believes that successful traders need to track how institutional players, banks, hedge funds, are positioning themselves in the markets and how these players impact price. He emphasizes reading the markets by observing how price reacts at key levels, interpreting this as a reflection of institutional behavior. ICT also focuses heavily on institutional order flow. His core teaching is about identifying when and where institutional players are placing their orders and how retail traders can follow the smart money. ICT's concept of order blocks, where institutions place large orders, directly reflects the notion of understanding institutional order flow. Overlap influence. ICT's emphasis on institutional order flow aligns very closely with Laurie's ideas. While it's hard to say definitively whether ICT borrowed this directly from Laurie, it's clear that both traders share a very similar foundational approach to understanding price movement through the lens of institutional behavior. 2. Price action and market structure. Laurie focuses a lot on pure price action and market structure, advocating for clean charts with minimal reliance on indicators. He teaches traders to analyze swing highs and lows, breaks of structure, and liquidity areas where price is likely to reverse or continue trending. His work emphasizes reading the market's intentions through these key structural points. ICT is a major proponent of price action and market structure as well. His method of trading around market structure, shifts, e.g. breaks in market structure, and liquidity pools is central to his trading approach. ICT's teaching on how to identify liquidity hunts and market structure breaks to capture moves is very similar to what Laurie emphasizes in his lessons. The focus on price action and market structure is a common thread between both traders. ICT's refinement of liquidity pools and structure shifts likely draws from established concepts like those taught by Chris Laurie, but ICT adds his own terminology, e.g. order blocks, fair value gaps. 3. Liquidity and stop hunts. Chris Laurie often discusses how markets move to find liquidity, particularly around areas where traders' stops are located. He teaches that large players will move markets toward these liquidity areas to fill their own positions. This concept is central to Laurie's view of how price is manipulated to create opportunities for institutional players. ICT's focus on liquidity and stop hunts is a cornerstone of his strategy. He teaches that markets are driven by the need for liquidity, with smart money targeting areas where stop losses often above swing highs or below swing lows. ICT frequently discusses liquidity pools as areas that institutions will move price toward before reversing it. Overlap influence. The idea that the market seeks out liquidity, particularly in the form of stop hunts, is almost identical in both traders' work. It seems likely that ICT may have borrowed or at least been influenced by this concept from Laurie, given how central it is to both traders' teachings. ICT's refinement lies in the specific ways he identifies and trades around these liquidity zones. Session-based analysis. Laurie places significant emphasis on understanding how different trading sessions, London, New York, etc., behave differently. He teaches that institutional players tend to be more active in certain sessions and price movements can be more predictable based on the time of day and session overlap. ICT also puts heavy emphasis on session-based analysis, particularly the London and New York sessions. He teaches that these are the times when institutional traders are most active, and many of his strategies revolve around identifying key times in the market when liquidity hunts or reversals are likely to occur. He refers to this as the kill zones where volatility and institutional activity spike. Overlap influence. The focus on session-based price movement is another area where ICT's teachings seem to align with those of Chris Laurie. Both traders focus on the importance of understanding institutional behavior across different trading sessions. While ICT's use of kill zones is a more defined concept, the underlying principle is consistent with Laurie's teachings. Market manipulation. Laurie discusses market manipulation extensively, particularly the idea that large players, banks, institutions use market-moving tactics to create liquidity for themselves. He emphasizes the idea that retail traders often fall victim to these manipulations and that understanding how and why these manipulations occur is key to trading successfully. ICT is very vocal about market manipulation, particularly how institutions engineer liquidity by creating false breakouts, targeting retail stop losses, and moving price in ways that create liquidity for themselves. His concept of liquidity voids and breaker blocks is directly tied to his view that market movements are manipulated by large players. Overlap influence. The concept of market manipulation is fundamental to both traders' teachings. While Laurie addresses it more broadly in terms of institutional behavior, ICT has created a more structured framework around these ideas with specific trading tools, e.g. order blocks, fair value gaps, to capitalize on market manipulation. ICT likely took inspiration from this concept and expanded on it with more detailed trading strategies. 6. Understanding institutional intentions. Laurie places great importance on understanding the intentions behind institutional order flow. He teaches traders to think in terms of how institutions are positioning themselves and why they are moving price in a certain direction. By aligning oneself with institutional players, traders can avoid getting caught in retail traps. ICT also teaches traders to think like institutions. He encourages them to understand where institutions are likely to place their orders, how they manipulate price to gain liquidity, and where retail traders are most likely to be trapped. His focus on order blocks and fair value gaps is an attempt to help retail traders align with institutional order flow. Overlap influence. The focus on understanding institutional intentions is another major similarity between Laurie's and ICT's approaches. While Laurie teaches this concept more generally, ICT has codified it into a series of specific tools and strategies that make it more actionable for traders. Summary of similarities. 1. Institutional order flow. Both traders emphasize tracking institutional behavior as the key to successful trading. Price action and market structure. Both focus heavily on clean price action and interpreting market structure to understand how institutions are positioning themselves. 3. Liquidity and stop hunts. Both teach that the market moves to hunt liquidity, particularly targeting retail traders' stop losses. 4. Session-based analysis. Both focus on the importance of understanding how different trading sessions impact market behavior and liquidity. 5. Market manipulation. Both discuss market manipulation extensively, though ICT has formalized the concept more in his own terminology. 6. Institutional intentions. Both emphasize the importance of thinking like institutions and aligning with their order flow.
ChatGPT crashed, so I'm going to finish the rest of what she was saying. So the summary of differences. terminology and structure, ICT has developed a more defined system with specific terms like order blocks, fair value gaps, and liquidity voids. While Laurie touches on similar concepts, he doesn't package them in the same structured way. Intraday focus. Laurie's teachings tend to be more broadly applicable across different time frames, whereas ICT is highly focused on intraday trading, with precise timing around session opens and specific liquidity events. And I think the conclusion is the most important. And this is from ChatGPT. It's very likely that ICT borrowed or was influenced by some of Chris Laurie's ideas, particularly in the areas of institutional order flow, liquidity hunts, and market structure. ICT has taken many of these core concepts and expanded upon them in his own unique terminology and strategies, making them more actionable for retail traders. While Laurie may not have formalized these ideas in the same way ICT has, the foundational principles behind both traders' teachings are remarkably similar. So, my original premise was, if ICT, as he claims, either wrote the algorithm or helped write the algorithm or saw the code that the algorithm runs on, then why would he have needed to expand upon or borrow ideas from another trader? It's just something I would like you to think about. Feel free to leave your comments and continue the discussion below this video.
What's all this business about gold block levels?